Starting in the US, where Tesla revealed the biggest slump in earnings in more than a decade as the road gets increasingly rocky for the electric car industry. Tesla made profits of $1.1 billion in the first 3 months of the year. That's a fall of 55% on this time last year. Revenues were 9% lower, and both numbers were worse than investors had been expecting. But Tesla shares, well, they've taken a real pounding this year. They actually jumped by nearly 12% in after-hours trade after the company promised quicker progress on new, more affordable models. Erin Delmill has been looking at the numbers.
It's been a rocky road for Tesla this year. Higher interest rates are taking a bite out of consumers' purchasing power and pushing big purchases out of reach. Competition with China, especially rival electric vehicle maker BYD, is heating up. Sales have been falling, and so has Tesla's stock. It's down more than 40% this year.
The Model Y.
The company's been cutting prices and announced layoffs. And then on Tuesday, the company reported its first quarter earnings, missing expectations on earnings and revenue. And the company is anticipating lower deliveries this year compared to 2023. But investors have one bright spot to look to. Tesla announced it's speeding up the launch of a lower-priced vehicle. More affordable models could be a boon for cash-strapped U.S. consumers and a hit in big competitive markets worldwide like China and India.
Erin Delmore there. Well, I also spoke to Seth Goldstein, who's a strategist at the investment managers Morningstar, where he chairs their committee on electric vehicles. He gave us his reaction to the results from Tesla.
Well, we knew that deliveries were going to fall, and so we were likely going to see a revenue decline and a larger profit decline due to the challenges in the quarter. Not only just lower sales, but the production issues, as well as ramping up new vehicles like the Cybertruck that were going to weigh on profits. But looking at the quarter, the bad news is already largely known. So now, the question for investors was, what was Tesla's strategy going forward? Were they going to cancel the affordable vehicle, as was rumored in the media, or were they going to continue it? And Tesla said they're going to accelerate it, plus full self-driving is on track to start generating more and more revenue. So looking forward, I think the bad news was largely priced into the stock. Tesla confirmed their strategy, and that's why we saw the stock rise in after hours, despite results coming in below consensus.
Now, of course, what's going on with Tesla reflects what's going on in the global economy, and things have changed radically since this firm first came to our attention and was a disruptor within the car industry. Now, every big car maker in the world is getting its electric vehicles out there. So just talk us through the future for Tesla as the competition gets tougher.
Well, now Tesla is no longer the first mover. They don't have that advantage of being the incumbent in the market. Now they have to make the case to consumers of why you should buy a Tesla versus another vehicle. Especially Tesla was one of the first long-range electric vehicles versus early EVs had a much shorter range, usually half the range of a Tesla or less. And so that was pretty easy for consumers who wanted the longer range to choose a Tesla. Now Tesla has to rely on things like the full self-driving, rely on the performance specs, the battery life, offering consumers more infotainment while they charge, those sorts of ancillary products and services as a reason to buy Tesla over another EV brand, because the EV market, especially in the luxury space where Tesla currently operates, is largely saturated with new players and incumbents. And so Tesla no longer enjoys having that sort of market dominance that they once had.
And just quickly, Seth, are you concerned at all about Elon Musk still being in charge of Tesla as the boss, as CEO? There was a lot of conversation some time ago when he bought X and the wrangling and the legal wranglings over X, that he was not focused on Tesla enough. He was busy with other things.
Well, Elon confirmed on the earnings call that he spends the majority of his time at Tesla, and I think we've seen a very strong management team from Tesla that includes Tom Zhu, who's the effective COO, who makes a lot of the pricing and manufacturing decisions. And so I think Elon is more than capable of continuing to be the CEO of Tesla, as well as meet his other business ventures. And with X, he's taking more of a technology role. He's not the CEO of that company, so I think he'll be able to run Tesla, and Tesla will still be able to meet their goals.
Interesting. Seth Goldstein there from Morningstar. Well, Tesla is the first of the so-called Magnificent Seven. That's the tech companies that dominate US markets to report quarterly earnings. Today, we'll be hearing from Facebook and Instagram owner Meta. Thursday, we have results from Google owner Alphabet as well as Microsoft. Over the past week or so, around $1 trillion has been wiped off the value of big tech companies. But on Tuesday, US markets were higher with the tech-heavy Nasdaq index up 1.6%. So maybe some optimism is coming across.